Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
The implication from that is we have bubbles that are too big to fail. And because they're too big to fail, the next decade is, if I had to summarize in one sentence, is the transformation of bubbles into inflation. And it's something that, again, I was calling in the middle of COVID and even before, everybody was, depression and the end of the world and hyper deflation. And look, guys, we knew central banks in some way were going to come in. We didn't expect necessarily the speed and the size and whatever and how far they've gone. But yes, there are lots of deflationary pressures, economic activity, unemployment, technology, demographics, overcapacity, malinvestment. All these things are deflationary. Yes, granted. But there's one force called money printing, which offsets these and more by a long way. So you create this perception of stability. You think, oh, things are stable. No, they're not. You have effectively things collapsing, inflation rampant.
All right, Happy New Year, everyone. We've turned the page, but we're still in an era where global policy can change with a tweet. The pandemic is still not under control, and stock markets are still at all-time highs and bond yields at all-time lows. So we're excited to have as our first guest in the new year a man who can talk global macro, volatility, bond yields, correlation, oil, metals, and more. We have Diego Parrilla, managing partner at Quadriga Asset Management. Or is it asset managers, who not only heads up the team over at Quadriga, but is also an accomplished author, economist, and linguist. So thanks for joining us, Diego.
It's my pleasure, Jeff. Thank you so much for having me.
And in today's Zoom world, you're calling in from Madrid, right?
That's right.
And you just mentioned before we got started, it might snow there this week?
Yeah, it's unusually cold.
Snow. I didn't even know that was possible.
Yeah, Madrid is, I think it's about 700 meters high. It's in a plateau and it's lovely weather, pretty dry, but it can get cold as well.
Yeah, I've been a couple times. We do some business with a guy actually at a iBroker, but I'll have to get back and we'll have a cerveza or something. What I love about Spain the most is there's no, in America, right? You say you want a beer, and there's like, which one of these 40 types of beer? In Spain, they have one beer on tap, and that's what you get.
Yeah, the flip side is if you ask for wine, they'll show you 40, and you go somewhere else, and they only have one wine. So that's granularity for you.
Yeah. And how are things there did you guys just go back into lockdown?
It's been moderate. We have curfew. Lockdown. The restaurants are open, but over the holidays, been closed at midnight, and you could actually during the festive days you could even go later, 1 a.m. And they restricted the number of people, but at least things are somewhat normal. Although the pickup of infections is going up, so I think across Europe we're starting to see things tightening up. But I must say, Madrid feels quiet, but somewhat within some degree of normality. So we've been going to museums and going to restaurants, even if that meant there were less people around.
Yeah, the Chicago museums are still closed. Still pretty abnormal here in Chicago, but hopefully get the vaccine spread around and back going. And so you're a former competitive football and tennis player. I'm assuming that's not American football.
20 kilos ago,
20
soccer.
kilos ago.
Yeah, we have some former professionals in the family, and there's, I think soccer, most Spanish people have some familiarity. Some of us have played a higher level, but yeah, it was a lot of fun to play internationally with university and also competitively here in Spain. And yeah, very passionate about sports in many ways. And there's even lots of lessons to be applied and learned into markets, I think, as you look through. So this will be the work of a future book, which we may talk about some other time.
Yeah. What position were you?
I've always played offensive, kind of striker, but yeah, number 10, I guess.
Yeah, the false
For those who are
nine.
familiar with it. Yeah.
A little bit. I coached my son's team, and then I played in high school, then chose American football in college. I think looking back, I should have chosen soccer in college, but that's neither here nor there. And then you're also fluent in a couple languages. How many?
Well, I'm obviously Spanish. I lived and studied in France and the US, and lived in the UK for a long time. I lived in Singapore and picked up Chinese, which I can talk a little bit, studying with my kids, and Italian. So I just love it. It's one of my passions. The first one is the hardest. The second one is tough. I think after the third, it sort of comes. I think your brain gives up and picks them up a little bit more easily.
Yeah, I'm always amazed. Americans just don't have that in their psyche of learn the different languages. I think it's a failing of our American society overall, of like, it should be front and center. We kind of have Spanish or French in schools, but it should be a little more important to our schooling system, I think.
I think it's very much part of culture, and if you get to experience in a country, I think you get to really go far deeper than you would if you communicate in English. But you're lucky that you don't have to learn those languages. For many of us, it's been a necessity. But yeah,
it's kind of, I view it as unlucky.
It's fun. It's fun.
I would have rather had to. So how'd you get from athlete to into the market? What was some of the first roles?
I've always been amateur. I've been a tennis coach and competed, but I would consider myself a professional, even if I got paid. And never really at that high level. But I'm from a family of engineers. I followed my dad's tradition into mining and energy. I was very lucky. I finished top of my university and got a scholarship to study my master's in France at in the French Institute of Petroleum and the Colorado School of Mines in Golden. So I did my thesis in mineral economics, and I specialized in something called real options, which back in the mid-late 90s was a very new thing, and that gave me the opportunity to pick up a job with in the markets.
What were those rail options?
Real. Like, just to give you a sense, my professor, which greatly influenced my thinking, basically would describe a lettuce as the right but not the obligation to have a salad. It's effectively a call option on a salad, and that idea of everything in life is an option is fascinating. And if you dig deeper into the theory and you apply it, life it's all about options. So I think there's a lot of added value, I think, in understanding options theory and options trading as part of every day-to-day decisions that we make.
Yeah, you'll like this quick story of a prop firm here in Chicago. The owner thinks in total optionality, everything he sees. And so they ended up buying a I can't remember the team, but one of the Premier League teams. But when they were in the third division, and basically he saw the optionality of like, if these new TV rights get going, if they get promoted to the second league, he was doing the math, and this could be worth. So I think they bought in for, it was like a 10 or 20x trade from where they bought in. The TV rights came in, they got promoted, and then they eventually ended up selling it. But yeah, you'd think people buying soccer teams would be vanity trade or something, but he was just seeing all the optionality.
So I even describe books as options, right? You buy it, you spend whatever $10. Nobody's gonna force you to read it, but that's the premium spent, and the payout of a good book could be worth tens of thousands or hundreds of thousands of dollars. So everything, I think it's relationships, every decision you make. I think it's anything that is asymmetric gives you this optionality, and yeah, I know we use the lingo and Vegas and deltas and things, but it's what it is. It's probabilistic, and I think it's helpful for decision making and risk management.
Yeah. So you went from Colorado School of Mines, French Institute of Petroleum. Then you got hired where?
JP Morgan in London.
Okay.
That was it was an interesting time. It was sort of mid-late 90s, so $10 oil, $250 gold. And it was a time when most of the banks were actually exiting commodity markets, emerging market crisis, Russian default, and every bank was sort of wondering, why are we in this game? And JP actually kept precious metals. So even if my background was more in the energy space, I joined the foreign exchange and precious metals division, and that was actually a very valuable thing. The link is to me it was great, and that triangle of energy, precious metals, and FX macro, it's really where I've gravitated most of my career in different functions. Across trading and managing teams and selling and structuring, and yeah, in different regions. I was lucky to work for some of the best teams out there, like Goldman's commodities team was phenomenal, and then I had global responsibilities with Merrill, and so I've been very blessed. I've been able to build these businesses in multiple dimensions across London, New York, Singapore, globally. So I did my 2 decades around the world before I finally made it back home, where I never worked before, and in that process I transitioned from investment banking to the hedge fund world with my own firm, and then with some large macros.
And in those JP and Goldman, all those, were you structuring trades for big commercials, or what were the trades looking like that you were doing on those desks?
I started out as a market maker of precious metals derivatives, and effectively you had the obligation to make markets on certain underlines and payoffs. And as part of that, we were very closely involved in structuring solutions both for investors and corporate clients. And for corporate clients, you had both consumer, producer, and refiners. So yeah, those roles give you a tremendous amount of a very rounded vision of the industry, of all the players, of the hedge funds, of the specs, of the consumers, of the physical. And I think these building blocks actually add up. And once you understand effects, for example, moving into precious, there are lots of similarities with effects. There's some nuisances of the physical commodity markets. And over the years, as you complement that with energy and storage and contangos, and it's all the same building blocks. Things just change slightly. Been involved in providing solutions, some of them quite innovative, and I have several cases in my career where I've been very blessed to be able to develop those solutions both on the investor as well as the corporate side.
Got it. So you weren't necessarily on the other side of all these big hedge funds trades or whatnot. You were just providing the market maker service, as it were, hedging out the book for the bank.
Yeah, that's right. I mean, you provide ideas, you provide liquidity, you execute, but it's not just hedge funds. You have, very often the opportunity or the axe that you might have in the book comes from, let's say, a consumer buying, and that gives you the opportunity to be more competitive with a producer that wants to sell or whatever. So I think this is all trying to, facilitate liquidity and solutions across players, and hedge funds, have been very helpful in providing very often that curve exposure or volatility or volume that you couldn't accommodate yourself for risk limits or differences in timing with these markets. So that source of risk premia has been a very fascinating area of the opportunities in the commodity space because of the extreme volatility and many degrees of freedom that we have relative to other markets. Our forward curves are much more dynamic and alive, and the volatility and seasonality and physical constraints. So it's a great school, I think, and there's been some very big traders that come from the commodities school, including Lloyd Blankfein or Gary Cohen, which is today in the news. I think he's been appointed vice chairman of IBM. He was the aluminum trader at Goldman.
Oh, really?
Yeah. So he knows one thing or two about commodity markets.
And so then somewhere in there, you found time to write 2 books?
Yeah, I think this is, it's a very, I look back, it's a bit like climbing a mountain. You're doing it, and when you look back, you realize, what you've achieved. But it's something that came quite naturally. I always say that, you think you know it, but until you put it in writing, you don't really realize how well or how badly you know it. And I think I think it was Cicero who said, if you want to learn, teach. I would say, if you want to learn, write. I think those 2 books have been incredibly educational for me, first and foremost. And just the process of structuring your own ideas, putting together the thesis, etc., was super powerful. And it's a discipline that I've kept, and that I hope, as you said, you use the word, did you find time? It's the ideas are there. It's something that requires a significant amount of investment and effort, but I strongly recommend that everybody pursues their passion and writes about something they care about, because you will find that you learn an incredible amount, and sometimes you're able to help people, which has been very, very touching, to continue to get strong positive feedback from people that have had a positive experience, and they learned something from that. So it's something I'm really proud of. It was a big effort.
I've been trying to write a book for like 6 years now, so I can't find the time to. But I think what you're saying, if it's not, you don't really need the time. If it's stuck in your head and it needs to get out, it's going to get out, right? But what were the 2? There's 2 books, right? Which one was first?
First book was called The Energy World is Flat. I co-wrote it with my good friend Daniel Lacalle, who had previous experience writing, and it was written in 2014. It took about 9 months to write, and it was a very contrarian thesis at the time. The oil market was about $120. Peak oil theory with 200 oil was consensus, and we were calling for the flattening of the energy world, the convergence across energies, the convergence across regions, and it didn't take long before things did happen, and the thesis was not only survived, it was actually reinforced. And I think this framework, this is just the way I think the wiring in my brain, is something that I applied to a second book. This time, the book was called The Anti-Bubbles, and also very contrarian at the time. I know the ideas, if you read the book today, they might look more obvious, but it was calling for 3,000 to 5,000 gold, very critical of the monetary and fiscal policies without limits, and this effectively process that we've seen accelerate over the last few years. And yeah, so both, I would say that they were, if you went to an airport to buy it, you could see probably in the science fiction department. And
that's
then
the only department I look in. So.
And then slowly they moved into current affairs, and now both, I think, are going more into history, because the script has played out or is playing out pretty much by the letter.
And I'll be sorry to tell you that I went to find it on Apple Books to listen to on my long drive home last night, and it's not on there to listen to. So
no audiobooks. Yeah.
But so Energy World is flat. The concept was, hey, natural gas, solar, everything's going to come up and energy is going to come down, and we'll just have it as kind of all same price, same demand. What?
Yeah, I think the starting point is that energy markets have always been very siloed. So prior to our book, you could find great books on crude oil. You could find great books about coal, great books about natural gas, great books and a lot of work about renewables. But there was no real cross-section because of a number of reasons. The flattening, the concept of the flattening of the energy world, it probably rings the bell to many of you. It was actually inspired in The World is Flat by Friedman, Thomas Friedman, which was a post-mortem analysis of the dot-com bubble.
Yeah.
And it's a book that I read shortly after the dot-com exploded. It's interesting time now, because I think we're relatively close to something similar happening. But it was fascinating, the fact that as we lived through, those of us who lived the dot-com in first person, it kind of had a bitter meaning. We just gone through the bubble, and this book was fascinating because it was talking about something transformational that happened. You said, look, we had this amazing technology, these things called broadband and all these things, which is fantastic. That basically led to these huge investments, which meant the entire oceans were wired with basically broadband and fiber optic and stuff, on the expectation that you would earn a killing for then you would make a fortune of that, which effectively led to overcapacity. And that overcapacity meant prices collapsed and investments were written off. And then magic happened, because you had an incredible technology in huge size for free. And so pretty much overnight, places like India or China, which had been much more isolated from things like outsourcing. If you were an accountant in India, you couldn't dream of giving your services to someone in California. So that flattening of the world was actually a really optimistic view, and in fact, it's really what's happened. And so that concept stayed in my mind. And when we saw a few things happen in the energy space, in particular, the book starts with Fukushima. How effectively the earthquake, the tsunami, and the nuclear crisis that we had created this massive spike in natural gas prices, which went to about $20 an MMBTU, which is $120 per barrel equivalent, when the exact same molecules were trading in the US at $2 an MMBTU, so at 10% of the price. And this was because of the other big move, which was fracking, right, and shale. So you had this parallel, which was, we have this incredible technology, we have this price signal, and so it became fairly clear to me that places like Australia or others would make these huge investments. Even Israel became a major energy producer because of some findings in gas, and natural gas, which had been, for obvious reasons, very much a regional commodity, because you had to either build a pipe or liquefy it, which is a 5 to 10 billion investment. Suddenly you had this major investment. So the idea was, look, you have the technology, you have this price incentive, you have this huge overcapacity. We will see things like natural gas becoming global, and more abundant, and then this creates a number of dynamics. But everybody's very familiar with what I call the battle for supply in the case of energy. So this is Canadian oil sands competing with fracking, competing with offshore, competing with conventional, with whoever, and this is like a civil war between producers. And then what is less well understood is the battle for demand, is the fact that and this is it can lead to people to think that OPEC, for example, it's the success of OPEC is because they have an oligopoly of oil. It's like, look, I control the oil, I control the price, and it's not really true. The reason OPEC was so successful was more because they had a monopoly of demand. So if you wanted to drive your car or a plane or a truck or a boat, it was oil, gasoline, diesel. So in a world where you have trains that can go on LNG or cars that are electric, effectively that battle for demand is real. And so all these flattening forces, and I think in the book I analyzed about 24, which we packaged into 10 big forces, effectively reinforce this thesis that, look, these silos are going to break. Energy is going to become more global. And then it was pretty clear who the losers and the winners might be. And things like oil at $120, it was just a matter of when, not if, that oil would collapse. And I think we had this quote, which was, at the time, it was considered to be outrageous. It was like beyond science fiction, Mad Max, which was, and the last barrel of oil will be worth zero, not millions. And at that time, people looked at us saying, are you out of your mind?
Yeah, you were off by negative $36.
Exactly. And then it went negative, and that's just insane. So no, I think that process was a lot of fun. I talked about learning earlier, and it was fascinating because as we have these theses, it's a very humble approach. When you have a thesis, you're already positioning yourself in a position of, this is just a thesis. I'm not in possession of the truth. So you're there to be proven wrong. And as we were throwing basically things like, nat gas and whatever to the thesis, then you mentioned solar and renewables. It was fascinating because I must admit I didn't know that much and at the time. And the question would be, how does renewables fit in the process? And one of the fascinating things is that it actually reinforced the process, and things clicked even better. And we've seen how the flattening of the energy world continues. I just bought my first electric car, which I will get delivery on Friday.
Nice.
And I think
it's a European version.
European. No, we went for an e-tron, an Audi e-tron.
Nice.
So we replaced a Q7 for an e-tron, and it's I think we're in that tipping point where they've been viewed really like city cars, and I think we're starting to see the network developing. And so look, the flattening continues. All these things that we discussed have happened in a number of ways, but it's a very dynamic world.
One of those things, like you said, looking back, it seems obvious, right? Like in what we feed all our animals here in the United States, if corn gets too expensive, we give them soybeans. If soybean gets too expensive, give them rice, whatever. So it's like fungible what you can feed them, and you go to the lowest cost. Same thing with American and the world, right? If beef gets too expensive, people switch to pork. If pork gets too expensive, they switch to chicken. So it's the same thing, right? Like just over a much longer time frame.
That's
you can't
exactly
switch
right.
your factory in a day like you can at the supermarket, but you could switch it in 6 months, 18 months.
That's 100% correct. And I think this is a major mistake that many oil companies have made. I mean, it's happened many times in history, right? People forget that what we really need, nobody needs oil per se. You don't need oil. I don't need oil. You want
power.
You want basically, in terms of transportation, I want to go from point A to B in the cheapest, most reliable, most environmentally friendly way possible. That's the ask. So, but many oil companies, they think we need oil, and we don't. Okay, if you find a cheaper, more reliable, abundant, cleaner way of doing this, we will. And this is why technology is at the forefront of these battles and these boundaries, and it's fascinating. And you can see how the limits, that might have been, negative energy prices, right? That immediately creates a massive incentive for batteries and all sorts of accumulation of energy and other things. And so it's fascinating. It's all interrelated. It's very fluid. And as you said, I think it's down to us consumers. We have that choice, and people who don't understand what they're really providing, and they get, whether it's Polaroid or Nokia, or an energy company, if you don't really understand the need but focus on your product, then you probably have a problem.
Hey, Nokia did all right. They made a nice sale to Microsoft, right? But the product, became obsolete rather quick. The second book was the same concept, but FX and gold, you're saying? A similar
the idea is similar. I mean, to me, I guess both books were challenging the status quo. Both books presented a contrarian thesis, which was, again, considered science fiction at the time. And in the second book, I challenged this idea that you can actually solve problems by printing money and borrowing. And we had seen already at the time, negative interest rates being introduced in Europe, and what challenged, I mean, what I found shocking is how they were pushing the boundaries, and changing the rules of the game. And you sort of wonder, look, is it really as simple as this? Can we really just solve problems, whether it's Lehman or whatever, by literally just printing and borrowing? How does this end, right? And as you start this chess game in your head of how do things go from here, and you start pursuing those paths, you actually can go in multiple directions. But once you push this far enough, you get to conclusions like I did, which was a paradigm shift. And that paradigm shift is what happened in the energy markets, which I described earlier. It was just a matter of when, not if. And that paradigm shift it's happened in the last few years, and is accelerated with COVID. And we're in a new phase. I mean, if I was to summarize the previous, call it, decade of financial markets, it's very simple. I think it's the transformation of risk-free interest into interest-free risk. And that's really what we've done. Once upon a time, you had the 10-year bond, or the 30-year bond, or the 10-year treasury paying you 5%. You had this concept called risk-free interest. You get paid 5% for doing nothing, for taking no risk. You were effectively making real returns because inflation was low. And on top of that, if there was a crisis and interest rates went down to zero, your 10-year bond at 5% would make you 50% capital gains. So the entire industry was built upon, I have that's why I called it for those who follow soccer, I called the Bund Beckenbauer. That was this very famous German footballer in the 70s. And yeah, it was a great defender at the time. The guy is 74 years old today. Okay, so the Bund played that great defending job.
When I say it's like a life jacket you get paid to wear, right?
Exactly, a lot, and it will work. And that paradigm has changed. There's no such thing as risk-free interest anymore. Okay, there's negative interest rates in Europe, and the US is on its way. We have that's in nominal terms. We have, I think this week we've seen 10-year break-evens, inflation, breaking 2%, and deeply negative real yields in the US. So you are getting paid 90 basis points for your 10-year treasury. You think you're making money, but the reality is your purchase power is being eroded by over 1.1% net of inflation. And then on top of that, your defender is no longer there. So that's the entire model, the industry built on 60-40 portfolios. Okay, yeah. I have some equities, some bonds. The idea was, look, I am protected, right? I have my strikers, I have my goalkeepers, my defenders. Now you have effectively what you've created is artificially high prices. Artificially low interest rates have created artificially high prices. Anything that it's valued using discounted cash flows, right? Which is most things, right? If you are going to receive a cash flow of $100 in 1 year or 10 years or 30 years or 50 years, with interest rates at 5%, the present value of that thing will be whatever, 60 cents, 30 cents, 20 cents, 8 cents. Okay, today with interest rates at zero, it's 100. So any company with, not only the present value of those cash flows is artificially high, the desperation for yields and the P's are so high, the equity duration so high, that the long story short, what we've done in the last decade is we have created these massive bubbles that are now too big to fail. So we're in a situation where the enemy has changed. The rules of the game have changed, and central banks, somewhat unwillingly or unknowingly, have been forced to step in to provide the support that, of course, is trying to prevent the utter collapse of the system. But the only thing it's done is created these bubbles that by now are too big to fail. So we're in a situation where,
but it's also too big to fail. So it's like, so a few things there. One, I read an interesting article of like, this is how money should work, right? Like if I want to give someone my money to keep safe, and then they give it back to me in 5 years, shouldn't I pay them something to protect that and give it back to me? Right? It's kind of like the whole concept of me giving you my money, you give me interest and then give it back to me safe. Seems like, you can turn the whole thing on its head and say that doesn't make sense either, even though that's what we are accustomed to for hundreds of years.
Look, what we're experiencing, there's no other word, is financial bullying. Okay, we are being forced, this idea of saving, we are obviously penalizing savers with negative interest rates. We're forcing people to spend, to invest. Some of it will be needed, some of it and useful. A lot of it is marginal. A lot of it is highly speculative and malinvestment. And so we're in a situation that is very fragile. And this is pre-COVID. I mean, we're in a situation where the damage was already done. What COVID has done is obviously created a huge shock that has forced central banks and governments to do more of the same
we tripled down on what we already had in place, right?
And all it's done, yeah.
That's another good concept of everyone was saying the same things after 2008, right? Like there's too much, we've taken on too much, this is going to create a huge bubble. And then
it has done.
It has, but it's like if I can sell my artificially inflated stocks and buy gold or buy real assets. So, to me, like it's artificially inflated, but you can still use those profits to purchase real goods.
No, of course. I think this goes down to the wealth effect. Okay. Yeah. Whoever, we're not going to discuss. I mean, I have no interest in going too deep into Bitcoin whatsoever, but I'm of the view that the emperor has no clothes. Okay, and there's these things that you just create. I mean, I was offered to do my own crypto for 25 grand, right? You do your Malik coin tomorrow for 25 grand. You have your own. It's like, okay, so I can do my own coin, use it for this, and I'm going to be a billionaire. Come on, guys, let's get real. I can see the benefits. I can see the rationale. I know exactly what's happening with the dollar. We know exactly what's happening. We know the problems of fiat, all these things. But at the same time, you know, there's money that is created out of thin air because of, you know, Tesla, which, by the way, I think it's, I don't know, I'd venture to say that we're going to see 20-30% one day move in one of these assets any day. That money didn't exist. It's not real. It's just castles in the air. Is a house of cards, and you know, multiples of 1400 it just doesn't exist. But it creates this sense of wealth. People feel rich, they spend and whatever. But we've seen this movie before several times, and I think that
those Tesla options and sold out, the money's real. You got the money out.
Of course, yeah. It's always the greater fool, right?
Yeah.
So that's the same for many things. I mean, look, I think the point I was trying to make is, first of all, we've gone through a transition where we've gone from risk-free interest to interest-free risk. The implication from that is we have bubbles that are too big to fail. And because they're too big to fail, the next decade is, if I had to summarize in one sentence, is the transformation of bubbles into inflation. And it's something that, again, I was calling in the middle of COVID and even before, everybody was, you know, depression and the end of the world and hyper deflation. And look, guys, we knew central banks in some way were going to come in. We didn't expect necessarily the speed and the size and whatever and how far they've gone. But yes, there are lots of deflationary pressures, you know, economic activity, unemployment, technology, demographics, you know, overcapacity, malinvestment. All these things are deflationary. Yes, granted. But there's one force called money printing, which offsets these and more by a long way. So you create this perception of stability. You think, oh, things are stable. No, they're not. You have effectively things collapsing, inflation rampant. And so what we're starting to see, and I think is something that will accelerate, is precisely to your point that you made just now is, yeah, you can transform these things into real stuff, okay, into real assets, whether it's land or houses or gold. So ultimately, there are things you can print. You know, yeah, you cannot print Bitcoin, yeah, but you can print, you know, other cryptos. There, how many? Yeah. There are 10,000 cryptos. I mean, of course you can print cryptos. There's 10,000s of them. So in that sense, look, I think we are in a very, very fragile moment.
And you're saying when I turn those into real assets, that causes real inflation?
No, inflation, let's define inflation, okay? This is a very simple idea, but it's not, I think, well enough understood. Inflation is not about your house going up or bread going up. Inflation is about the value of the money with which you buy a house and you buy bread going down. And it's a very big difference.
Yeah.
Okay. If you go to Argentina, if I just gave you a bunch of papers from Venezuela, you laugh at me. I mean, kids play with it. It's paper.
Yeah,
okay.
Yeah.
So those bolivars were worth something. Those Argentinian pesos were worth something. Those French, I mean, it's the value of the money that is going down. And you don't need to be a genius to realize that the money is going down because we're printing trillions of it. And it's as simple as that. So inflation comes because you have finite things, and it's the denominator that is changing. It's converging to zero, right? So in a way, this is the reason why equity markets are going up. Of course, they're going up. I mean, there's some degree of, you know, your interest rates are low. The units that you sell, everything is worth more. So in a way, the high equity prices are a reflection of of inflation in one way, right? It's asset price inflation. But this is the what some people are shocked. It's like, oh my God, we're in the middle of a crisis. There's all this unemployment and house prices are going up. How is that possible? It's like, dude, it's just about the amount of money in the system. And that's what inflation is about.
There's separate inflation, right? There's the 1% inflation of the top 1% people, I'm saying, not the rate of inflation, but they have their own inflation, right? Of like houses in Aspen and private jets and those kind of, but the price of bread may be perfectly fine.
I think inflation is going to be, it's the single most important asset and risk in the next 10 years, and it's accelerating. And this is it's the way out. Okay, think about it. If you took $1 trillion mortgage, can you afford it?
No.
Yes, you can. At 0% interest, interest only, you can. Now, you can, I can, okay? At 0.1%, I cannot. Okay.
Yeah.
That's the reason why interest rates are not going up, full stop, okay? And this is the bluff of the central banks. We have this perception that you think you can print and borrow and increase your debt 20-fold or whatever you want. And then everything looks okay because you've printed this money, you've spent, you kept activity, you built bridges and whatever. The reality is you're only able to support that debt because interest rates are artificial.
Right.
And if interest rates go up and or credit spreads go up, you go bankrupt immediately. A country like Spain, which was on the brink of collapse and had to be pretty much bailed out, as you know, once the 10-year reaches the 7.5%, the cost of servicing the debt is so high that you cannot do anything else, and you go automatically, it just spirals into the abyss, right? So that's kind of a critical point, 7.5% in the 10-year. That's when everybody just goes knock knock. We need some help, right? And we were there, and just a few years later, we are borrowing at negative interest rates in the 10-year. I mean, that is not a reflection of the market. That is a reflection of someone printing trillions of dollars and giving them at artificially cheap levels. So the central bank, the left pocket,
your economy didn't improve 1,000-fold, right? To go from the 7.5% to negative rates.
No, in fact, the problem is this. You take so much debt, and you can afford it because rates are artificially low. At negative interest rates, you and I can take a $10 trillion mortgage. In fact,
what are we buying? An aircraft carrier?
Exactly. So at negative interest rates, you're incentivized to maximize your debt because you're getting paid for taking debt.
Yeah.
So of course people will do that, and of course countries will do it, and Greece and Spain. That doesn't mean that that's the fair value at which you should be lending them. It's 100% artificial. Interest rates are artificial. Credit spreads are artificial. Everything's artificial. Valuations are artificial. But it's so big, the problem, that there's no way back.
Because let's define what you mean by artificial. So not tied to reality, you're saying? Not tied to the real supply-demand economics?
That's right. So artificial, it just means it's not real. It's not a reflection of if the central bank stepped out, just went to the toilet for 10 minutes and wasn't there supporting the price.
Right.
Nobody would do this.
And we're getting philosophical, but that's why they'll never step out, right? Which is what
they can't.
But that's why it'll stay inflated perhaps indefinitely, right?
And that's why
is there a problem if it just stays inflated?
Well, this is the thing, that the perception, in fact, the narrative of central banks is for decades, if we were talking to our grandparents, let's say, they know who the enemy is. The enemy is called inflation.
Yeah.
Because they've seen it, right? And if you talk to an Argentinian person or Venezuelan or whatever, now they actually told us that the enemy is deflation. Our friend is inflation. We need more inflation. We want more inflation. We'll do whatever it takes to get this inflation. And before you talked about, obviously, a very important point, which is inflation. Your inflation is different from mine and from others. CPI is complete crap. It's not a reflection of real inflation. And so many of these dynamics are all related. But ultimately, I think this idea that, you know, it's incentivizing a lot. So let's say you want to buy a house for, pick a number, you know, $100,000, right? And you take a mortgage for 99, right? As inflation comes in 10 years, your house might be worth 500,000, but your debt is still 99, right? So in a world where interest rates are artificially low, they cannot go up, inflation's coming, it leads you into the second wave of inflation. Inflation there are two phases, okay? Phase one is 2 + 2 = 4. So, you know, you print more money, things go up.
Yeah.
And phase two is inflation expectations. This is when you go to a supermarket in Argentina, to pick one, and you've seen these pictures of this, you know, where they says bread, 100 million.
Yeah.
And then that's 9 in the morning. 12 in the morning, scratched, 150 million.
Yeah.
Of course, the central bank didn't print 50% more money in that process. People know that money is worthless and it's just burning in their hands. And once it starts burning in your hands, because it becomes very obvious that, you know, inflation is accelerating.
Yeah, I don't care to give you 50 million more.
Then it creates inflation. It's worth zero anyway. You just, you know, so in a way, this is why 2% is such an important number. Okay, it's not. I define this in the book as the frog in boiling water. You're probably familiar with what happens. I've never seen it, but I understand that if you put up a frog in boiling water, it jumps. But if you put it in mild water and you increase the temperature, it will die. It will never jump. So we are frogs in the boiling water of inflation.
But we got put in the cold water, and the heat's been turned up.
Exactly. So at 2% per annum, it's not big enough for us to jump. But we've been diluted by 2% per annum officially by a while, which means that in 10 years, your purchase power is lost over 20%. If you compound that over 20 years or 20 odd years, I've stolen 50% of your purchase power in 20 years.
Yeah.
Okay. 20 years at my age, or 20 years, not what it used to be. Okay.
Yeah.
It used to be a long time. Now it's yesterday, right? But 50% of your money has been stolen by money printing. So that's at 2%. If inflation increases at 5 or 10, you know, very, very quickly, all your money is gone. And this is something that, you know, I saw a tweet today. Someone was saying, "Oh, inflation expectations, you know, break evens in the 10 years above 2%. The Fed will hike rates before the end of the year." I'm sorry, mate. And this is if you play this game and if you go by the rules of the game, you take a textbook, any of the books you have there in your background.
Yeah.
You pick one of those books, and it says, if inflation goes up, central banks will hike rates because they need to fight inflation, right? That's what the book says. The reality is we cannot hike rates, because if you hike rates, the entire system collapses. So
I've been saying that on here for a while. The real estate guy we had on, I'm like, what? There's no way rates are ever going up. The whole economy is built on low rates.
They're not going up. And I think this is something that when I first wrote about this, it was considered science fiction. It's like, okay, guys, the rules of the game have changed. Think about it as you will have zero interest rates and inflation. This is why, for example, I think the 30-year tip, even if CPIs or break-evens or whatever are not a fair reflection of inflation, it's not a bad trade, because you have the full upside on nominal yields plus inflation pickup. So it does make sense. to play the 30-year tip.
And do you feel like private lenders and like groups will split from the Fed and say like, hey, I've got to make a return here. I know the real risk. I'm going to raise rates myself, or that's a losing game because
you have two components, right? You have the actual interest rate, or three: interest rate, credit spread, and inflation, right? And interest rates are controlled, and the central bank will set them, and they will be zero or negative globally, I think, and they won't move much. I think there are limits to how negative you can go. I don't think you go beyond 1%. Okay. Credit spreads, yeah, I could basically lend differently to Walmart or to Jeff Malik.
Yeah.
But even then, the reason central banks stepped in and not only buy government bonds, but they buy corporate bonds, it's because they want to short circuit the credit process, and they cannot rely on me buying the treasury of the bank and hopefully the bank will lend it. They just go and say, screw that, I'm lending directly to these people. And even if it's in the investment grade space, the higher quality firms, obviously it creates a big difference, because if your top telecom is able to find itself from the Fed, then the number 2 or 3 in line benefit from that, right? So it creates a domino effect. And then the inflation side, I think, is the degree of freedom. And I think this is, it's pretty obvious. I mean, but the problem and the sad thing is, this is the reason why we have inequality. And this is the reason why, if you read a bit of or listen to Ray Dalio, he talks about all these things of the repeat of the effectively the mistakes of the 30s and how they got us into trouble. But it's happening. And I think the sad thing is, you can see people unhappy, people losing purchase power. They've been told that there's no inflation, but they go to the supermarket and they can afford less and less, or schools or houses. And these people are not happy. And of course, I think,
well, I think in the US we see it most in healthcare, right? Of like,
well,
I can still afford food, housing, a little problematic, but healthcare is just a straight line up.
Yeah. And this is leading to inequalities, leading to many issues, which they can't point at who's to blame, right? We're always looking for scapegoats, and Trump was looking after China. China's the guilty guys. Like, come on, guys, don't. This is all coming from these things, and central banks. I'm reading this new book from Mervyn King now. Quite interesting. I only just started, but it looks interesting, and on the decision making process. And it's just very humbling how he's the former governor of the Bank of England openly saying, our decision making abilities and tools, we have no idea what's happening, we have no idea what we're doing, and we have no idea what will happen. And let's face it, all these, it's fascinating. He calls it.
He's the former head of the central bank.
Yeah, radical uncertainty.
He's broken out. He's broken ranks and said we have no idea.
Oh yeah, big time. He wrote The Alchemy of Finance, and he's a very critical guy of MMT, and I think it's fascinating and it's interesting. But it's really all these things that are happening. It's just people are worried about how we eat, it's hand to mouth. It's how do we avoid the next company blowing up? How do we? And you're taking these mini steps that are taking you into an abyss. And back to your question,
planting a tree for 15 years from now.
Yeah, back to your question. I think it becomes an issue of how we are we solving the problems? And the answer is no. We are doing 4 things. We're delaying the problems. So when you take excessive debt, you're kicking the can down the road. So you're delaying things. Second of all, you're transferring the problems. So effectively, the devaluation of the dollar, it's transferring the problem through competitive devaluation to Europe and others, right? We saw this clearly in 2008 and how Europe blew up, partially because of the weaker dollar, etc. The third thing that is happening is that we're transforming the problem from bubbles into inflation. But all these 3 things, delaying, transferring, and transforming, are actually enlarging the problem. And this is the thing. It's like today,
enlarging it in the future.
Exactly. So the issue is anybody who's lived through, what our grandparents or whatever had to live through, realize that's the evil problem. If you ask somebody in Argentina, but we are foolishly thinking, oh, that will never happen to us. And of course, it sounds like science fiction today, but the path we're taking and some of the measures that are being taken, are brutal. And this is the reason why, I'm not hitting on Bitcoin whatsoever. I just think, of course, people say, screw that. I mean, who wants to keep their money into dollars? Let's just go somewhere else. But I think ultimately,
I want to get an MMTer on here and have you guys debate it, because they would come. You could get 10 people on here to say, "Hey, all that debt, all those deficits don't matter. We can wipe it away. We can remove ones and zeros from the digital balance sheet at the Fed. Everything's fine." Right. And as proof, they'll point to, we did all this in 2008 and everything is fine right now.
No, they didn't, because all we did in 2008 was test the limits of monetary policy. We did something that was within the rules of the game, which was, let's bring interest rates to zero, print money, lend it to the governments, and hope, cross our fingers, that their actions will actually work and they will be able to repay things back. But let me be very clear, QE1 was needed, okay? If you, the way to put it simply for those who are less familiar with macro, you basically sat all the 7 banks and said, okay, how big is your problem? 100 billion, yours 150, yours 200, whatever. They sum it up, 600 billion, and they said, okay, I'm going to print 700 billion and give it to these guys to cover the hole. That action was needed because not stopping that snowball would have resulted in much bigger consequences. Okay, and it didn't have. It was offsetting deflationary pressures, and it kind of increased the monetary base by a somewhat not marginal amount, but it's what it is. The problem becomes when Europe defends itself because the euro went to 150, 160. So we need to do it, and we even need to go further. And Japan and the other. And so as everybody does the same, this is subject to the law of diminishing returns. It's like an asymptotic process, right? Where you have to print bigger and bigger quantities of money for smaller and smaller and smaller benefits. And this is the reason why QE3, if you remember, was called QE infinity. Because the market was like, come on, how much you're going to do? 5 trillion? Whatever. 2 minutes, it was gone. It's like, no, we're going to do whatever it takes. And that's the dynamic we're in. This is whatever it takes.
Well, that's the narrative now, right? We'll
do
whatever.
But what happened, exactly. But what happened then was monetary. Was really on the monetary side with zero interest rates. What we've seen since then is negative interest rates. It's lending not just to governments, but also to corporates. And we are seeing effectively money printing, which is directly being given to consumers in the form of checks and grants and things that will be never paid back. So
fiscal.
The perception, it's going fiscal. The perception that nothing's happening, it's stupid. It's the equivalent of going to Chernobyl, after a nuclear accident and sitting there taking pictures and saying, you see, nothing's happening. And within 2 days, Chernobyl, within 2 days, all your teeth have gone, you're green, and it doesn't work, right? So, green meaning that you glow, you're dead, right? Not that. so in that sense, there's a delayed effect with many of these things. I think it's naive to think that you can just solve these things by just printing and removing zeros. Something's given, and yes, you may resolve one problem, but we are delaying, transferring, and transforming. And on a global scale, this is something that I don't think is as easy to solve. In fact, I think it's getting worse.
And it's gonna, no matter, even if it works long term, there's going to be second order effects that nobody's thinking about as well, right?
Absolutely.
So we've identified all the problems in the world, maybe not all of them, but one really big one. So talk to us about what you're doing at Quadriga, how you kind of tackle these thoughts that you have, and and what your risk and reward payoff is if you get some of these ideas correct.
Yeah, look, what I've done is I think going back to my point on portfolio construction, I use this analogy of a soccer team. I think this investment game. I think Warren Buffett describes it. He says there's only two rules. One, never lose money, and two, never forget rule number one. Right? That's everybody knows that, which is a bit cynical and not entirely true, because they can lose 50 or 60% in a big crisis. But I think what he really means with those two rules, which is the way I would translate them, is this is a game of capital preservation and compounding on capital preservation. Because if you lose 90% of your money, you need to go up, from 10 to you need to go 1,000%. So effectively, to do that, if you bring the football analogy, we can talk about, most people think that investing is really about making money. So Jeff, here's 100 grand, invest it for me, make me money. And that means capital gains, income gains, whatever. Now, in reality, that's what I would describe as a striker. You have people in the team that are responsible for scoring goals. They're responsible for making money, right? But the team also has to protect the capital. They need to protect the goal, etc. So there are people in the team that are more goalkeepers, defenders, and midfielders, people who generate alpha. So I am the goalkeeper. My strategy is designed to do very well during crisis. Okay, it's based on the anti-bubble concept, which is the title of my second book, which is an idea that I coined. It's almost like if you think about bubbles are about asset prices that are artificially high, based on a misconception, based on a false belief. So what I said is, look. Misconceptions can distort prices, but not only with artificially high valuations, you could also have artificially low valuations. So an anti-bubble has three dimensions. The first dimension would be assets that are grossly artificially cheap, based on a misconception. The second is, bubbles and anti-bubbles are like distorted mirror images of each other, because they're effectively two reflections of the same misconception. So they can think about, so by construction, the moment the misconception is understood and the bubble bursts is the exact same moment that the anti-bubble reflates. And third, there's an element of risk premia, because if you think, for example, about, or a good relationship is the VIX and the S&P. The S&P and the VIX, in my view, are a bubble anti-bubble relationship, because you have artificially low volatility can actually contribute to artificially high equity prices, right? So ultimately, around the framework, the macro ideas we discussed, the concept of anti-bubble, we basically invest, or we have a strategy that looks for assets that are anti-bubble, anti-crisis. They do well during the crisis. These are things like the VIX, or gold, or inflation, or many, right? You could buy puts on the S&P. You effectively, it's by construction. That's my mandate. So we were the best.
You're hesitant to call yourself like a tail risk fund, though.
Yeah, except that tail risk is slightly different. The goalkeeper is a bit more. The tail risk funds will do well in very extreme scenarios, in those very, very small tails. We're designed to do very well in those tails, but we are also designed to do. We were up. I mean, yesterday, for example, we're up 4%. With the S&P down and gold up. You don't need a 30% move in the S&P to make money. But as a goalkeeper, the beauty is how the team works. So I think ultimately, my recommendation to people is build portfolios that are well diversified. I think one of the key consequences from my thesis, and one of the key things that we've seen is false diversification. So the risk of false diversification is the fact that when people build a portfolio, they have, they're long equities, credit, high yield, EM, commodities, whatever, private equity, private debt, and you say, I'm diversified.
Yeah.
But the reality is that when, excuse my French, shit hits the fan and boom, we have a Q4 18 or a Q1 2020, turns out that every single position in your portfolio collapsed at the same time. So the reality is that you were not diversified. You had false diversification. You thought you were diversified, but you weren't. We were the best hedge fund in the world in February. Effectively, we did well. But the idea is that you have something that when the team does well, you have strikers. When the team needs it, you have goalkeepers. And then, so I think the process has really 3 steps. Step 1 is you need to decide how you're going to play. Okay, but you can't play with 11 strikers. You can't play with 11 goalkeepers. You need to have a balanced team. The second step is you need to pick your players. Okay, do I want my striker to be the S&P or the NASDAQ or whatever? Do I want my goalkeeper to be the VIX or my strategy or whatever? And the third thing, and this is hugely important, is how you rebalance the team. And so instead of fighting the volatility of the market, instead of fighting the stupidity of the market,
harvest.
What you want is to take advantage of it. So if for the sake of argument, your team was 50% strikers, 50% goalkeepers, let's say the S&P and my strategy, and there are periods where, you know, the markets will move and, you know, we had the S&P at 3,400 and the VIX was at 11, right? Prior to the collapse. And then the market goes to 2,200 and 80% VIX. And then, you know, now we're back to 3,700 and the VIX actually holding well and looking like it might go again. But this process, if you did a basket that is passive, just 50-50, you would earn X. But if you're able to rebalance back to 50-50, so look, the market's going a bit crazy, the strikers are super expensive, I'll take some profits and buy some goalkeepers, and vice versa. The strikers are not very cheap, etc. You can actually achieve incremental returns which are hugely relevant. And so ultimately, investing for me is not about having a crystal ball. It's not about, oh, I'm smarter than you, this is going to go up tomorrow, whatever. It's about build your strategy. So have a balanced team with strikers, defenders, and goalkeepers, and pick your players that do their job and rebalance. And if you do that, you make money whilst you sleep at night because you will always be, I think, balanced and on the right position. The problem comes when you have the wrong strategy, you only have strikers, or you build your team, you think you have defenders, and they turn out to be a CTA that is max long at the top. And
right. Yeah, or I'm in equity and private equity. I'm diversified. Well,
yeah, and
two different kinds of
or you don't develop, and then you don't rebalance, and then your 50-50 has become 80-20.
Yeah.
And by the time the market collapses, you everything goes. So,
but just to be clear, you don't have the beta. You're not the striker. You're just the goalkeeper.
We're the goalkeeper. Our strategy has 3 pillars. We invest in gold. We're big believers in gold. We think it'll be 3,000 to 5,000 in the next 3 to 5 years. We believe in treasuries and tips. But the most exciting part of the strategy is the third bucket, which is insurance, options. We only buy options. This is something that differentiates us. We don't sell options. So the risk is controlled by the premium. And we buy stuff that is 5, 10, 20 times premium in terms of payout. And we do this in a totally asset class agnostic manner. So we spend 5 to 7% per annum. We have options in 2021, 22, 23, and beyond. And we do all sorts of stuff, things that will benefit if there's a crisis, VIX higher, gold higher, equities lower, China lower, whatever.
Yeah, and it's a unique strategy there. So it's what termed complex options, right? So you're not just buying puts on the S&P or calls on gold or whatnot.
No, that's right. It's a bit like, insurance options markets are insurance markets. And, I give you a simple example to show you what I mean. Yeah. When I lived in Singapore, I was working for the bank, and then I left, I set up on my own, and I took over the insurance from the bank. I had a very comprehensive package, and they quoted me, and I'm just going to make the numbers up, but for the sake of argument, I have a family and stuff. It's like, okay, Diego, that's going to be $30,000 a year. Like, wow, that's a lot of money. And I say, yeah, but you have global coverage. And it's like, yeah, but so what does that mean? It's like, yeah, for example, do you ever go to the US? And I was like, Yeah, but on business, right? It's like, oh, that's fine. If you don't go to the US, then it's 10 grand. And I was like, what? 20K out of the 30K insurance from a global insurance was attributed to the US. So if you buy a vanilla option, you're buying health insurance in any country, anytime, any whatever.
Yeah.
But if you fine tune that insurance and you say, look, I don't live in the US. If I go to the US, then maybe I'll get my insurance for a week with my Amex or whatever. But that's my point. So when you actually fine tune the markets and you say, look, yes, I want, I'll give you one example. You could say, I want insurance in case S&P goes down 5%, and the market will pay you 3-1. And you say, well, I also like insurance if gold goes up 5%, and the market will also pay you 3-1. Okay. What if I want insurance when gold goes up and equities go down at the same time? And here the market might pay you 12-1. So you're basically reducing the premium, increasing the payoff, and improving the carry by fine-tuning a distribution, because the market says, Diego, if gold is up, equities will be up. That's kind of, if the markets were uncorrelated, the implied correlation in the market was 0, theoretically, your 3-1 and 3-1 should be 9-1.
Yeah.
Okay. But if you actually get to play with better odds because the market has a different view on correlation, then you can get better things. So the fact that we do more, let's say, customized insurance doesn't mean it's riskier. It means it's less likely to pay off according to the models, but it's cheaper and it's more explosive and potentially better carry.
And I view them as like parlays in sports betting. Is that similar? Fair?
I'm not an expert there, but yes.
Yeah.
Yes.
Well, it's instead of I'm going to bet on one team to win, I'm going to bet on and the odds are
absolutely
-250. If I parlay that with two other teams, the odds go in my favor. But as you're saying, it's much less likely to happen. You have to get all three right.
That's right.
So this is an interesting point, though, because a professional sports gambler would basically say never do parlays. But they're also right. But they're also fixed odds, and the house has it, skewed heavily in their favor. But how do you weigh that? So you're basically betting that your probability calculations are better than the banks.
No, first of all, there's a supply and demand of correlation. So what happens is many of these structures, you asked me at the beginning, do you work with corporates and whatever? Some people, let's say that in Korea, a Korean bank wants to do a gold product. They want the gold product denominated in Korean won, not in US dollars. So the gold option that they buy pays the upside of gold in dollars, because that's what people see. Oh, gold is up 20% in dollars.
Yeah.
But they want it paid in Korean won. So in a scenario where the Korean won is gone up or down, let's say 20% relative to the dollar, even if gold is up 20%, maybe if the won is down 20%, the payoff would be 0. So to hedge that correlation, the bank offers this product. They obviously do it with a nice spread on correlation, but the client gets what they want. The bank protects itself. And now the bank has a correlation risk. So they go to people like us and say, or the other way around, I will generate this. But I'll say, look, Diego, correlation can only be between -1 and +1. Someone just did it at +0.9. I've done my full size, but I'm beyond my limits. I'm happy to do this at mids or whatever, get me out. And so we only do this when it makes sense. But the key thing I want to say is that we don't create more customized options for the sake of making them more complex. We do them because they add more value. Okay. In some cases, it's like in some cases it feels stupid because the market is giving you better odds with things that I like to use one example. I use soccer, but what are the odds of Barcelona winning the league? And the market says 2-1. Okay. And you say, what are the odds of Barcelona scoring more than 100 goals in the season? or winning the league and scoring more than 100 goals in the season, and they will give you 6-1, and it's like it's the same trade. If you're gonna win the league,
they're gonna score that many goals.
So you're like, and then Messi will do better than, and you're like, it's the same trade, but instead of doing it at 2-1, you might be getting it at 6-1 or 10-1. So what's the point of doing it at 2-1? Of course, it's not the same trade exactly, but my point is that what for you might look like the same trade, you could do either risking less money or getting better odds. But either way,
the world of somewhere in there by you or the bank is a real probability of that happening, right?
The probability is, look, you can look at the probability. Let's look at something super simple, right? Gold and euro. Okay, let's look at the probability distribution of gold. You have an options market, very developed. Let's look at the euro dollar. Same thing, probability distribution, options market. Okay, how about gold in euro? What's the probability of gold in euro? Okay, it's interesting because the correlations are actually very unstable. So you could have a situation where gold and euro are moving the same way, and this looks normal. And so if gold and euro are moving the same way, it means that gold in euros is not moving at all. So the implied volatility of gold in euros could look really, really low. But you know that in a crisis, two things happen. One is volatility might explode, and second, correlations might break. So something as gold in euro, if you take advantage of very high implied volatility and low vol, what happens is when the crisis comes, this thing becomes super explosive because you have two things compounding in the same direction. And this is what you want, because I as an engineer, and I look at the parallels between some of the stuff, science and markets, and there's lots of them, but I think volatility is a bit like fluid mechanics. You go from a laminar regime to a turbulent regime. Mm-hmm. And so in that sense, these jumps in behavior are something that when the bank makes you a market on correlation, is giving you some sort of implied correlation how they think the market's going to behave. But in a binary world where you're either laminar or explosive or turbulent, if you're able to accumulate correlation at laminar prices, when the crisis comes, you get this massive payoff. And that's in a way what we try to do. Of course, if so this crisis...
you're almost long volatility through the volatility of the correlation, not the volatility of
as well. Both.
But it's a fixed payout, right?
Well, you can construct these things as you wish. You can do
So I usually hear you quoting it 10-1, 15-1, but that's just as example. So some of your options will have convexity and they can pay out more as the trade goes in your
correct. The 5-1, 10-1, 20-1 are digital payouts. So it's literally like in sports. You have you will get $100 payout, and we buy them or $1 payout, and you buy them at 10 cents on the dollar. So that would be a 10-1.
And so, but you're not seeking out anything in the world. Like if S&P goes up and Tesla goes up, they're all still within your mandate and with your thesis of I want it to be protective, I want it to be crisis performer.
Exactly. So that means that, for example, on the equity side, we have a bias to be long puts on the short term. But from an inflation perspective, we're actually long calls, let's say contingent on pretty cool trade. Equity is higher, rates lower. Okay, that's a trade that we did last year at very, very good odds, 10-1, because the consensus of the market and the implied correlation is the opposite, and because of the shape of the forwards. And that's a 5-year trade, but it's an inflationary trade that will benefit if equities are higher and rates stay where they are or lower. That 30 above 3,200 and below 50 basis points in the 5-year. That's 10-1.
And just to be clear for our listeners, this isn't. I can't go on my Interactive Brokers account and click on these options. So you're calling around to different prime brokers. You're getting quotes. How does that whole process work?
No, I used to run those desks. I know exactly how they work. You need a special documentation, things like ISDAs.
Yeah.
We do this, customized to our needs in terms of size and maturity and strikes. And in some cases, we are the market. I mean, we are in a way the providers of liquidity but as you said, always within the angle of what our mandate is. So the way I understand our mandate is: can you protect our capital? Can you make money in a crisis? And can you, do it with the best carry possible, right? That's the goal. And within that, we think that gold and treasuries and options are nice way to achieve this. And so we can't and we don't just do whatever we want. We wake up in the morning and it looks like this thing is, now we like the Brazilian
right, it's a
real.
40 to 1, and I think the odds are 80 to 1. I'm going to buy.
It's always biased to crisis, pain during a crisis. But you could hedge yourself and find ways that hopefully will keep you alive.
And is the crisis skewed towards a U.S. crisis, towards S&P?
We do for practical reasons. We do, and it's been it's part of liquidity. It's a global index. We would have been better off buying puts on other things most of the time, because it's been a great striker to fight against. But but yeah, it's
you need that old German guy.
It's part of the decision or the discretion that we have when we look to buy those puts.
And when you say buy puts, they're often like a synthetic put structure, right?
No, we could do listed vanilla if it's cheap enough. We could do other things. So it doesn't mean we don't have to. This is like in football, you can only score with your right leg. No, maybe I can score with my left leg or with a header. It depends where the ball is coming. But if you put a player and he can only do forehands in tennis, that's like you can only buy vanilla listed. Okay, that means probably Rafael Nadal would still beat everybody 6-love. Just with forehands, because he can run around. But most humans would struggle. I think my point is, sometimes it's better to do something vanilla. Sometimes for example, in the VIX, we only do vanilla stuff listed. But for FX or gold or equities, you can actually do pretty cool stuff in other forms.
Do you think that's VIX because the banks just haven't caught up yet? They're too scared of the spreads are too big?
Multiple reasons, liquidity, and also the ability to structure this stuff. As you pointed out earlier, the bid offers, the capacity, you can't do this in anything. You need the ability to get in, you need the ability to get out, and you need to be able to do it at the right price. And for our sort of size, where we have billions of this kind of insurance, then you want to make sure that, these things are liquid and both on the way in and out.
And that's interesting. So how many of these are there at any one time in the portfolio? Dozens? Hundreds?
Oh yeah, we have probably about 100, although they fall within clusters. So we try to avoid having the exact same expiry, strike, etc. So or counterparty. So we may have a few, but I would say probably about 20 trades, 20 themes, kind of 20 differentiated trades over 100 lines. So some of them is the same trade over a different maturity or strike.
And the maturities are going out, you said 30 years?
All the way out 30 years,
30 years. So how does that work with an investor? Does the investor need to be around for 30 years? Or
no,
are you going to mark the market over whatever period?
No, the market to market, 30 years, that option is a small part. I would say, everything we do is very liquid. We are a daily liquidity fund. So about 80% of the fund is, let's say, gold and treasuries. 20% is in options.
Okay, yeah.
And out of that 20, at least 15%. So 95% of the fund is inside of 3 years.
Yeah. But even though it's just 20% in the options, that's going to give the biggest kick in a crisis?
That could be, if you have 20% at, let's say, an average of 10 to 1, that could make you 200%.
Yeah. All right. I love it. Anything else on the parlays? So you mentioned the double digital. That just means it's a fixed payout, and then the other options have normal payouts.
There's just two conditions too. A digital is, Rafa wins or loses. What are the odds?
Yeah.
And the dual digital is Rafa wins and Roger wins. So
Right.
Two matches. And if the market thinks that they're uncorrelated, which probably are,
Yeah.
you should be. But if the market's telling you that they are strongly negatively correlated or strongly positively correlated, if Rafa wins, for sure Federer will win. Then it depends. But yeah, you could think about this as Lego. You have these pieces, and ultimately we're playing with probability distributions. We're trying to identify value and buy optionality that hopefully will pay, and that will pay a lot when we need it, and that if you're wrong, it will cost you less and it will bleed less while you wait. But it's not an easy job. I mean, we had a very strong Q1, we had a difficult Q2, still finished the year up nicely, but
Yeah, I was going to ask you about the difficult second half of the year. What was, you think it was a change in environment, or what happened?
I mean, it's obviously it was in hindsight. I think I remember doing some similar interview in a big event, and S&P was breaking 3,000, and everybody was like, what the hell? This is like, everybody had been shorting the thing from 2,500, 27, 29, 3,000. This is nuts. And I was like, it's just, I mean, it's just a number, right? But it was now at 3,700, nobody's blinking, and just a few months ago at 3,000. I mean, we've had some pretty major move. It's happened synchronously. I think the one thing that hurt us a bit was the big move in gold, which is honestly, I think a bit of an anomaly, or I don't see it. I can see that the whole market's telling you the dollar is worthless, Bitcoin is worth infinity, yet gold is useless and worthless. And the treasuries are telling you a story, real yields are telling you a story, and inflation's telling you a story. And the one thing that didn't add up was gold, and we're starting to see that reverse a little bit. So I think we'll see how the movie ends, but we think there's been a major cleanup in gold. Hopefully that part of the book will make it back. And some of the other insurance, I think there were lots of good ideas, but outcome. I think who and knows?
Were the options priced higher too because of the high volatility? So you were.
Yeah, it's part of the game. I mean, think about this. It's a bit like insurance, right?
Yeah, the hurricane had just come through. They're going to price the hurricane insurance.
Yeah, exactly. So ultimately, you want to be. This is a game in the long term. You want to manage your risk, be focused on what you're doing, and our strategy, I think, is predictable in the sense that you know what you own. Yes, some of this insurance, as it goes down and you rebalance the portfolio back and you buy more insurance and things keep going down and down and down, you can have it can hurt, but it's also the same process that made us very significant returns in other periods. And so we're very focused on the process and how we do it. And
so you're not changing anything. You're not saying the market.
No, we're just focused. It's like a goalkeeper. You there are parts of the match when everything's happening on the other side. Sometimes you get attacked, and you're part of your team player. We're trying to do our job the best we can. I think we're proud of what we've done, and we're very appreciative of the support from the clients.
The gold piece. So you lost on the gold piece, but it's not always long, right?
We have a big bias on gold. Yeah, long bias. We have a core. We are not pretending to be timing or having a crystal ball. Now we think it's going up, now it's going down. Our mandate is to be long gold, long treasuries, long options. It's just, can you be it in the smartest way possible?
Okay.
But investors know what they own. We're not a black box.
So you might be a little more weighted towards silver or something, like as a proxy to gold?
We're primarily driven by gold, but we have the ability to do relative value and options and other things. But I believe gold is the one, even if silver will be way more explosive. Most of our precious metals exposure is linked to gold.
And how do you, right? So you take like an ensemble approach in the options sleeve silo, but then you have a third of it in gold, right? Like, why not have gold just be part of the overall diversifier? Like, it seems overweight to gold.
Well, gold is central to our thesis, and I think gold will play a big role. But a delta one, just a long position on the ETF may or may not be, or miners may or may not be the most efficient way. I mean, what we do is we have a core allocation, roughly about 50% into precious, 20 to 30 in treasuries and tips, and 20 in options, roughly. And we have the ability to rotate and whatever, but that's fine. But the 20% in options, if you link it to gold and others, it can actually be way more explosive. So we're hopefully superior to just and complementary, perhaps, to other ways to do gold keeping. But ours is focused on anti-bubbles, anti-crisis, and within gold, treasuries, tips, and volatility, the VIX and insurance are.
And it's just U.S. treasuries and tips.
Yes.
Got it. I've had a long love-hate relationship with gold, so you'll have to convince me to come to the dark side, right? Because 20 years, right as I was coming up in the business, 20 years, it was just flat to, just went nowhere. Even it went down for those 20 years. So, but the last, what has it been? Last 20 years, it's been pretty good.
Yeah. Look, I think it's here to stay. It's going to be interesting. I think all this debate of gold versus Bitcoin and whatever is maybe put some people off, others. I think it's going to be an important asset going forward. And I think because of many of the dynamics that we discussed, I think it's going to gain an even bigger role. So it's a good. I think the risk reward is good, particularly with everything that's happening on the currency front. But yeah, time will tell. I think the book goes into a lot of detail into many of the arguments that have, if anything, strengthened. But look, I think we cover a lot of ground. I hope hopefully you guys found it of interest. If anybody wants to reach out, feel free.
You have 2 minutes to go through a quick favorite section.
Sure.
We won't have any debates. We just asked some favorites here. So, thanks for being with us. I'll go through real quick. Favorite team: Real Madrid, Atletico, Barcelona.
Atletico.
Atletico. All right. Favorite investing book outside your own?
Full by Randomness.
All right. Love it. Favorite place you've lived outside of Madrid?
Singapore.
Never been. I'll get back there. And are you do you consume podcasts or just participate on them? You have a favorite podcast?
I participate mostly.
All right. I'll give you some to listen to.
Thank you.
Favorite Spanish athlete of all time?
Rafael Nadal.
Yeah, he's unbelievable. Is he still going? Is he going to retire?
I love him. Yeah. It's my fourth son, according to my wife.
And lastly, favorite Star Wars character?
Yoda.
All right. All knowing, all seeing. Awesome. Well, we'll put links to all your stuff in the show notes as well as to the books. And we'll talk to you soon, Diego.
Thank you so much. It's been an absolute pleasure. Guys, much health and all the best in 2021. It's been a great pleasure. All the best. Thank you, guys. Take care.
Episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.